Hello and welcome to Personal Finance. I'm Gugulethu Cele. Financial institutions often inundate consumers with the option of credit. One such example highlighted by a viewer is a revolving loan. Wikus Olivier of DebtSafe joins me now to help us take a look at revolving loans versus credit cards. Good to have you again on this evening, Wikus.
Always a pleasure.
Maybe let's take a look at these particular two product offerings and get into the nitty-gritties as to what each entails. Let's start off with one that's familiar to the audience, which is a credit card.
Yeah, credit card is also a form of a revolving credit. It just says that you have access to a specific facility up to a certain amount, and you can pay that off and make use of it and pay it off and make use of it over a period of time. You can roll the outstanding balance across month to month, and that's basically how it works. Revolving loan, basically the same thing. The big difference there is that it's a fixed installment. With a credit card, the installments will fluctuate depending on how much you used, but on a revolving loan specifically, you also get access to a facility up to a certain amount, which you have to repay over a period of time.
Is the period of time locked in? Maybe a couple of months?
On the loan, it gets down to a specific interest rate, a fixed installment, and a fixed term as well. Many of these banks they market it that. There's different terms, and some of them will give you access to a facility 3 times your gross monthly salary.
That's
some of
huge,
them,
though.
It's huge. Some of them have an unlimited facility, depending on your affordability, of course. But all of them, it seems like they say on a revolving loan that you have to repay 15% before you get access to the funds there. Meaning that if you have a facility of 10,000 Rand and you make use of that 10,000 Rand, and you have to repay 15% at least of that 10,000 Rand that you took out as a loan in order to get access to the remaining facility again.
Oh, so there's certain restrictions and limitations placed there.
Yes.
But you mentioned the nitty-gritties there, and I think I was shocked by the revolving loan giving you such huge exposure to amount of credit, like you say, 3 times your gross salary. How do you know which one is right for you, Wikus?
Well, it comes down to planning and affordability, and also depending on what you want to do. Because your loans typically is if you want to buy something. There's something specific, maybe a television that you want to buy or something. And you can budget for it specifically because the installment amounts are fixed. So it just makes it easier to manage your finances around a revolving loan. With a credit card, it's a bit more difficult because it's not always as transparent as you want it to be. You're not fully aware most of the times of what you've spent on your credit card and how much did you put onto a budget facility, how much did you put on a straight facility. So it becomes a little more difficult to manage. But with the loans, it makes it a bit easier to not slide into debt too quickly, and you probably won't get any surprises there.
Tell us about that, because obviously with a credit card, it's instant, it's plastic. All you need to do is just swipe, and that comes with monthly costs as well as maintenance fees. And if you withdraw cash from an ATM, the additional fees as well, depending on the kind of bank. Versus a revolving loan, are there certain differences here with regard to the fee structure and costs?
Yeah, they're definitely a bit cheaper in terms of your interest rates, and also because the bank know exactly over how many months you are going to repay this loan. They are willing to negotiate on the costs there and give it to you at a cheaper rate. And I think consumers out there shouldn't confuse your revolving loan with things like an overdraft, because fundamentally they are sort of the same, but the revolving loan is outside of your check account. You manage it completely separately, and the costs are almost the same as the overdraft, so it's a good option for credit.
It almost sounds as though the revolving loan crosses several elements. Not only is it slightly similar to a credit card overdraft, as you mentioned, but maybe even a personal loan as well, or are there significant differences there?
Yeah, personal loan is also sort of the same, but it doesn't have the revolving thing. It's closed-ended. So you'll have a start date and a finish date when the amount is paid, and you won't have access to that personal loan facility. Then you have to reapply for a new loan. So the revolving loan facility just gives you that access on a continuous basis if an emergency arises, because they approve you beforehand and you'll always have access to that facility. With the new, like a personal loan, they'll have to do the whole affordability assessment things in terms of the Credit Act all over again. So I can see with the Credit Act amendments, a lot more of these revolving loans will be given out in the future. That's my opinion on it.
Doesn't that almost defeat the purpose then of this new Credit Act, where they're trying to minimize the amount of South African consumers who are actually under debt?
Yeah, not really, but I think they just make their own jobs easier. But because it's cheaper and it's more manageable for consumers, and there is a fixed installment, they won't get access to the facility in any case if they're not able to afford it. But yeah, it's better, cheaper than credit cards, and a better option if you want to buy something specific. Because credit cards have been designed to just, in case of an emergency or to manage your cash flow. But a revolving credit, in terms of a revolving loan, is there to give you a cheaper option on credit to see through certain emergencies.
What about the accessibility of the money, though? I think South African consumers probably love their credit cards because, as I mentioned, it's in your purse, available then and there. You swipe it any time. With a revolving loan, do you need to ask for a certain amount of money to be made available first?
Yeah, they usually have a minimum amount that, like FNB, I know there's I think a 5,000 Rand minimum that you can apply for on a revolving loan. But you apply like a normal loan, you just contact your bank and ask them about it. All of them differ. I don't know all the terms and nitty-gritty stuff that you have to go through with each bank. But it's an application process like you would apply for a bank account or for a loan or for a credit card, the same process. But it will be separate from your check account.
You touched on the interest rates and that the revolving loan is slightly cheaper, but what about credit limits? Because with a credit card, those fluctuate and sometimes the banks entice you with offers to increase it. On a revolving loan, can that ever be increased, or is it set at a fixed limit?
It's set at a fixed limit. There is options to increase it, but when they give you the credit, the installments and things are pre-calculated already. So they know if you have a facility of 10,000 Rand, 300 Rand will be your installment. So if you don't make use of it, you don't have to obviously pay an installment, or it won't cost you anything. But the moment that you make use of that facility, then that installment kicks in. And if they increase your facility in the meantime, or they won't increase it while you are repaying, then it obviously affects your installment amounts there. And they want to keep it fixed. That's the thing. Through my conversations with some of the banks, they said that this is a facility that they want to use to sort of educate consumers and to get them in that habit of paying monthly. With your credit card, many people just end up paying the minimum amount that they're supposed to pay. And hence they're rolling it over from month to month, and that's how they get into a debt spiral, because they don't know how much they owe actually on the credit card, and then they just keep on swiping it. With the loan facility, it's better because you know how much you owe, you know how much you're going to repay or how much you have to repay in terms of your credit agreement, and it's a bit safer.
Having spoken to you previously, I know you're not a fan of credit cards. You always say just cut it up, pay it off and forget about it. But in this particular instance, can both be potentially used by a South African consumer to help with their credit record or credit score, to show that there are consumers who can make use of credit and pay it off regularly? Or is it just best to stick with one particular option which suits your needs as a consumer?
Well, you can use both, but I think the statistics speak for itself. A credit card, you need to be disciplined to manage that thing correctly. And when you think about it logically, you can use it the same as the way that you use a revolving loan. There's an interest rate, there's an installment, but with the loan, the installment is calculated and the term is calculated for you already by the bank. So there's no work to be done from the consumer side. But with a credit card, you need to be aware of what you can afford beforehand, before you swipe that thing, and to swipe it is very easy. And then you need to have a plan already, a financial plan as to how are you going to repay that amount which you swiped on your credit card now. And that's where most of the consumers fail. So you can use both to get your credit score up, to show that you are a good payer, to build a good credit history, but the credit card isn't that safe. In my opinion, the loan is a safer option.
Discipline does sound as though it's the name of the game, but Wikus, if you could wrap it up for us in 5 key points, what would they be?
I would say to weigh your options. Just have a look at costs in terms of your, if you have facilities like an overdraft or your loan, if you want to apply for the loan or a credit card, compare the costs there to see which option will suit you better, and your wallet, which option will suit your wallet better. Then definitely, if you have a credit card there, plan before you spend on that thing. We know you can afford the credit card, but just go and plan and see before you swipe it. Maybe the revolving loan is better. And also for what you want to do with it. Weigh your options and see if the credit card is better, and you need quicker access to that because you already have the credit card, then by all means. But maybe you should hold back on the credit card and rather go and apply for a revolving loan, which is cheaper, which is easier to repay, and you'll always have access to those funds as well.
And I take it another key element here is to minimize the credit facilities that you have. Don't go out and get a credit card, a revolving loan, a personal loan, an overdraft, and open up several store accounts.
Yeah, definitely. Because the more credit that you've got, it affects your credit score as well. And the more that you apply, it also brings your score down. So keep it to the bare minimum and see which facility will suit your needs best. Just because everybody's doing it doesn't mean that you need to do it as well.
Wikus, thank you so much for sharing your insights with us today. That's where we have to leave it for personal finance this evening. A big thank you once more to Wikus Olivier from DebtSafe. Remember that we want to hear from you, so tweet any of your comments or suggestions to @CNBC Africa using the hashtag #Financed410 or to myself @Gukumfupi on Twitter. Until next time, it's goodbye.